Hey traders, welcome to a global macro update. Hopefully you're having a good week trading so far. We got some economic fundamental stuff that we're going to talk about at the start of the video, and then we're going to jump right into TradingView, looking at charts from different markets, different asset classes, and all that stuff. So first thing, we just want to talk about, will dollar rise or fall? Obviously, it's not even $1 million question. It's pretty much a $1 billion question, or trillion really. But basically, with the U.S. Federal Reserve printing a lot of currency, a lot of people are assuming that there's going to be inflation, hyperinflation, but there is the other side of the argument saying that there's a lot of dollar-denoted debt in the world, and if people need to pay off that debt, there's a lot of buying pressure that could come into the market and increase the value of the US dollar, and that's a cycle that would create a potential dollar short squeeze. But this is one side of it. The dollar is going to fall very, very sharply, warns predominant Yale economist. So we can see some people who are really well versed in the world of economics are arguing against Brent Johnson, dollar milkshake theory, and the other side of the story. So Stephen Roach, Yale University senior fellow and former Morgan Stanley Asian chairman, has warned for U.S. dollar bulls. Warning for U.S. dollar bulls. The prominent economist says that the area of U.S. buck may be coming to an end, as is forecasted a 35% decline soon in the U.S. currency against its major rivals, citing increases in the nation's deficit and dwindling savings. We'll see how it goes. He's thinking that the dollar will go instantly down. That is the overall outcome of this whole currency proliferation debasement. I think that he is correct, but in the short term, there is, in my opinion, a possibility for a short squeeze, because when we saw a entire global crash, looking at gold, silver, all commodities, global indexes around the world, what currency did the best? That is a key question that you have to ask. And if there is another crisis in which there's huge spreads of COVID, there's a sell-off due to solvency issues, something along the lines of that, what currency are people going to be looking to get into? Usually, when we saw it in the past, it's going to be things like USD and JPY. So in terms of currency crisis, in terms of the value of them going down substantially, could happen in the long term, but I think in the short term, we do have to consider that people like to go into the dollar when there's a huge sell-off. So this is a video that describes the US dollar short squeeze potential. You can watch it within our videos within Performante. Also, we do have timestamps, so we look at a bunch of different stuff. If you want to skip to a certain section, you can just click the time frame, and then it'll just jump you right there. So how do we assess the level of demand for US dollars in the world? I personally use this as one of my tools. It's the central bank liquidity swaps. What is this? Let's just scroll down a little bit. So the FOMC has authorized temporary reciprocal currency arrangements, so with certain foreign central banks, to help provide liquidity in US dollars to oversee markets. So basically, when central banks need US dollar, they will create their native currency and then put it in an account for the Federal Reserve, and then we send them US dollars, and then they provide US dollars for the corporations, companies that need it to transact on the global stage, really, because if you're transacting any commodities, you're going to be doing it in US dollars right now. And we can see it's not really slowing down. This is on a weekly basis, and we can see that the Federal Reserve is still providing liquidity to other central banks around the world. So overall, globally, countries still need the US dollar, so there's still a strong demand, and we can see that by the Federal Reserve providing liquidity to other central banks in the world. So Powell spoke recently, and they basically said that they'll use their full range of tools to aid the economy, which is basically just saying they'll print as much money as they need in order to try to stimulate the economy to continue the expansionary phase without having a bear market. They hate deflation. They are going to try to push for inflation as hard as they can, in my personal belief. And if that means printing almost unlimited amounts of money, that's what they'll do. They see Japan, they see that even with percentages of growth for the money supply exceeding like double digits, they're not getting that hyperinflation and significant inflation that a lot of economists are worrying about with an expansionary monetary base. So, people point at Japan and say, hey, they're doing it, why can't we continue to do it? Which is, in my opinion, a little bit dangerous. So we can see that the Fed is now going to purchase individual corporate bonds. I've already talked about purchasing ETFs, but now they're actually buying individual issuance they would be purchasing individual issuance on primary markets. Stocks added another leg higher on the news as the ETFs that track both investment grade and junk indexes. So they're really pulling out all guns and purchasing bonds for zombie companies. And we'll talk about zombie companies here in the next slide. So what even are zombie companies? So first thing, what are they? They're companies that are barely surviving and need cash injections to just pay the interest on the debt that they have. So they're really deep in the water, basically. So we can read right here. I'm going to get a little bit of coffee, and then we'll continue jumping into the article. All right. The Federal Reserve is lending a lot of companies a lot of money. This week, the central bank began buying individual corporate bonds, in addition to the bond exchange traded funds it has bought already, like we've talked about. But there's a growing worry in some quarters that all of this lending will create a wave of zombie companies. Zombies are businesses that have to borrow to survive and don't make enough profit to cover debt service costs. So, not positive, basically, in terms of a corporation. We can see that they're continuing to print money in order to fund these zombie corporations. They actually have slowed down a little bit since the start of COVID. But you can see there's a massive straight line up, and now within the weekly reports, we are slowing down. We're still increasing, but overall we are slowing down in the amount of money in the monetary base, as we can see. But in terms of the amount of money we've printed in the last, for example, 3 months, it's very substantial. Change in the last 3 months for the monetary base, let's just open this tab right up here, is around 16%. In the last 12 months, it's 23% more money in the total money supply. That's a substantial amount. Imagine if you did this for 10 years. You're more than doubling the amount of money. It's crazy. And we can see they're fourth in terms of the change in the last 3 months, under Argentina, Zimbabwe, and Venezuela. Like, how is that even possible in terms of the world reserve currency being fourth on the list of the highest change in the money supply in the last 3 months? That's really, really not a good sign in terms of the potential inflation, hyperinflation, devaluation, debasement of the world reserve currency. And that's going to be a massive shift in the world monetary policy, the world trade, and there's some opportunities to be made here. So now let's look at the money supply in the United States, which changed over 16% higher in the last 3 months. And we can see that right here. That big bump from, let's say, December of 2019, and then we see that in start of basically 2020. It's basically a straight line. We haven't seen anything as aggressive since, we can see, I guess, 2008, 2009, the initial Q1, and then Q2, Q3 were somewhere around here, and now we're kind of at that QE infinity kind of stage where quantitative easing was something that is not surprising at all, and is a continuous thing that the central banks are going to promote. So, yeah, a lot of money being printed. And is this really helping people in terms of more jobs being created? Yes, the initial claims is dropping, but this is brand new people filing unemployment claims. So yes, we had the initial spike due to the lockdowns, but we are slowly decreasing, but this is still 1.5 million new people filing for unemployment. That's still a substantial amount of people. So what we really want to be looking at is we really want to be looking at the continued claims, because I think this is a better representation of the overall economy after the lockdown, because if this is going down, that means people are getting off unemployment, going back to work, and that is a positive thing for an economy, obviously. But we see it stagnating, consolidating, going sideways, not really decreasing. We did get a little bit of a dip down from May 9th to May 16th in the economic data, but overall we are stalling here. And we are seeing a little bit of the economy open back up, but there is a spike in COVID cases. So it's a pretty difficult situation for people who are making the rules, basically. And just discussing the zombie companies just a little bit more. This was posted on March 31st, 2019. There's another post that is a little bit more recent, but it says 13% of the world's companies are zombies. That's not healthy, and that's Jerome Powell who said it right here. The number of zombie companies in advanced economies last year stood at 536 companies, or 13% of the total, according to Bank of America Merrill Lynch. That's pretty crazy. And why is that? It's because it's just so much cheap money. This is the world current interest rates. We see United States 0.25%, Australia 0.25%. You know, there's a lot of countries that are really at almost free money. If not, you even see Switzerland at negative rates, meaning you get paid to borrow money. So as a company, you can really easily survive making no money because it doesn't cost much to service the ever-growing amount of debt that you're getting into in order to fund your operations and expenses to try to build the company. So it's a really good environment for companies who have zero profit to continue operations because it doesn't cost much to borrow money. If interest rates do rise, that's going to be a major, major issue. But like Jerome Powell says, there is very, very little chance of any interest rate increases in the near term. So it's good for zombie companies for sure. And we can see this is another post for Canada, but it's a little bit more recent in February 2020. Businesses that have been operating for some time but have trouble generating enough income to cover their interest payments. That is the definition of a zombie company. And in 2018, around 25% of Canadian companies were considered zombies, the bank found. It also reported that a share of zombie firms in Canada has been increasing since the mid-1990s. That is a crazy stat in my personal view. And not really healthy. If a lot of corporations are unable to survive unless they have extremely low interest rates, that's not really a profitable company. That's not a company that is producing positive results in my view. Next thing we're going to look at is the long-term interest rates back to 1790 in the United States. And we can see huge swings, but I think the most prominent swing we can see, also a quick note before we talk about this big swing, is when the Federal Reserve was created in 1912, right here, 1913, 1912. But one of those years. And we can see since then it's been pretty crazy in terms of volatility. World War I, World War II, Great Depression, and the last time we had interest rates near zero, we were at around 2.1, a little over 2%, and that was in the 1950s going into the 60s. What happened because of extremely low interest rates? Look at this massive spike. And what happened was there was a huge worry of inflation. CPI numbers, which is Consumer Price Index, cost of goods and services, basket of goods and services, that shot up extremely high. And what they needed to do in order to control the inflation was to raise rates, increase the cost of borrowing money. So there's less money flowing in the overall economy, which is thus kind of taking away money, restricting the expansion of credit. And that's overall a deflationary measure to try to combat inflation. And we can see this is the Consumer Price Index, CPI, for all urban consumers in blue, and the red is going to be the effective federal funds rate, or what you call an interest rate. And they're pretty well positively correlated. It makes sense, right? So if the CPI numbers go up, the interest rate has to go up, because if the CPI numbers goes too high, it means inflation is just too great. There's runaway inflation. The cost of goods and services are going up so quickly like we've seen in Venezuela, in Weimar Republic, in Germany, in Zimbabwe. It happens. These things do occur. So they're really going to try to do everything they can in order to try to combat this, like we can see they've done in the past. There was crazy interest rates. We can see it was 13-14%. That's insane compared to what we see now at 0.25% or 25 basis points or 250 basis points. Basically like 1/4%. But I think this is inevitable in my personal belief. I think we'll have extremely low interest rates for a while in order to try to stimulate the overall economy. And it may work. That could be a possibility. We may not get a Great Depression type of move to the downside, but if we do get these low interest rates and cheap money to flow for too long, we will get inflation problems. That's, in my opinion, inevitable. If you increase the pool of the money to a certain point, it's going to devalue the units of currency, assets, whatever it is in that pool. So I think it's inevitable. And I think we will see interest rates spike quite substantially. And if that is the case, we will see gold and other safe haven assets like silver and I think Bitcoin absolutely skyrocket, like go to the moon. And we saw in 1960s into the 1970s was not too bad, and then the start of the 1970s to mid 1970s was pretty bad, and the late 70s was the worst of the inflation, right? Late 1970s was terrible. Interest rates were extremely high, CPI numbers were extremely high, and there was worry of inflation. In 1971, they even had to take the US dollar off the gold standard because they didn't have enough gold in the reserves in order to basically account for all the currency in circulation. So they took that off the golden standard and extremely pushed interest rates very high. But what happened to gold during that time? During the worry of inflation, during when CPI numbers were increasing substantially. Right, this is 1960s going into the 70s. So gold was stabilizing, not too crazy, at around $300. Dropped a little bit at the start of 1969 to 1970. Dropped a little bit, but from 1970 at $236, it rocketed up to $2,000 at the end of 1979 and 1980. So during around 70 to 80, that 10-year period, gold was on an absolute rocket ship. So this is 1970 to 1980. It went from like $250 to $2,000. So this is a huge opportunity, in my personal opinion, in the global macro sense in terms of inflation. But I do not think that this is going to come into fruition in the short term. I think there's going to be deflation, dollar increasing before we get the massive devaluation of the dollar and you get CPI numbers to increase exponentially. I just don't think that we're there yet. I think that the demographics is putting deflationary pressure within the economy. The decrease in velocity is putting deflationary pressure within the economy, and the lack of overall demand right now. But that things could change definitely. But in the short term, I think that's my personal view. So that's a little bit of fundamentals, a little bit of global macro. We're now going to get into more of the technicals, looking at some TA on some major assets. All right, so first things first, let's look at the S&P. Pretty key indicator of risk on, risk off sentiment. If it's going up, great risk on sentiment. If it's going down, risk off. Pretty simple. So let's start at the daily chart. We got a massive rejection off that 2960, like we said before. Extremely bullish candle with a wick to the downside and rejection from buyers, pushing it right back up higher than the open. Very strong. And then we got the break above the previous resistance right here, new level of support, which was the zone of sensitivity. We broke it, retested, and now it's holding as a new level of support. We can see that a little bit more clear within the 4-hour time frame. I did draw just a little descending zone. Not extremely well respected. It'd be nice if we did get another bump to the downside, testing this support zone yet again. And then if we get a nice little contraction in volatility, and then we get to either break to the upside or downside, that will give us a direction in which either investors are going to be looking at a risk-on sentiment, buying the S&P, buying Russell 2000, getting away from risk-off sentiment instruments, or we're going to get a move to the downside. We're going to be looking at risk-off sentiment opportunities. But in terms of the short term, I think we're just in a consolidation. I don't really want to be trading within this small range. I'd rather wait until a break and a confirmation that we're going to get either a move to the upside or downside in terms of the S&P. But that's my overall analysis. Very, very simple. Key level of support, and we got a potential series of lower highs. If it does break this support, I'm then going to be looking at a potential descending triangle like here, where you get a series of lower highs and a horizontal support at around 29.65, 29.70, and that's going to be the next structure. And I think it'd be a really good move from the break of 3,100-ish on the SPX down to the key level of support at 29.65, 29.60. So that's going to be the short-term potential risk off sentiment if it does break to the downside, and if it contracts in volatility closer and holds the $3,100 level of support, we could be moving to the upside to maybe hit the double top there. And that could be a little swing trade that we could do on any risk on opportunities that we see within the market. Bitcoin will probably be doing a little bit of a push up if it does break this resistance as well. So I don't want to be too quick to say that we're going to get a huge bearish push to the downside. It does look like it's holding the previous support yet again as a new level of support, which it was also a resistance back in June 12th, which is holding pretty nicely with lots of wicks to the downside, indicating buy pressure to push the price back up into the trading range. So overall, it's looking a little bit more bullish holding the support, but I'd say it is definitely in a position where it's very reactionary. I'm not going to say I know exactly it's going to go up or down. It's not super clear, so I'd just rather wait, stay patient, sit on the sidelines, sit on my hands, and wait until a better indication appears that gives me a better opportunity to have edge in the market. So that's the S&P. Russell 2000, very, very similar situation. This is more speculative small cap index. We see previous resistance, new level of support. We see it consolidate here. I think I'm just going to take this off just so we get a little bit better of a structure. So that's going to be the zone that we're currently holding right around there. And then we do see another one that is creating a very tight trading range that we're in right around here. But overall, we are making a potential higher high from here, but we could just draw that same descending zone that I'd like to see break. Ideally, in a perfect world, it'd be nice to see a little bit move to the downside, and then we get that third test for that resistance. And then if we break to the upside, that would give me a little bit more confidence in the move for the bulls. But in the short term, we're just contracting in volatility, and I think we'll squeeze in this a little bit deeper before we get our move. So I'm just going to go like this, and then I will just take this off. This was, if we just look on the daily, a pretty well-respected zone. I'm going to get this off right here. We have our initial anchor point, we have our first touch, and then we have a type B, and then now we got our fourth rejection. So this key ascending trend line is going to be a pretty important zone for the buyers to hold above, and we're now just contracting with a series of lower highs and higher lows towards the apex of the pattern, and we're just going to see which way it goes. There's no need to try to, in my opinion, I'm not looking for tiny intraday trades. I'd rather look for the break, the longer term impulsive push that we are looking for. So that's the Russell 2000. In a range, in a squeeze, looking for a break before we really take any action on the Russell 2000. In terms of the global equities, we are making a little bit of a move to the upside today. We've been consolidating. Yesterday was a pretty big consolidation. Today is just another consolidation within the same trading range. We haven't broken the previous candles high or low. We do got around 2 hours and 13 minutes before this candle closes, so we're not completely done with the day yet, but it does not look like we're really getting much done in terms of the overall moves for today. But we got a little bit of an island here, which is a potential reversal where you just get a lone series of candles there, break to the downside, and then if we closing the gap, that could be a potential continuation pattern. But overall, I'm mainly looking at the SPX and the Russell 2000, and this is going to basically be my longer term daily time frame analysis for more of the macro for risk on, risk off. So consolidation, nothing really too crazy right now, but overall it's definitely a little bit worrying for the bulls in my personal opinion, but don't want to jump to conclusions. Quick look at the VIX. strong move to the upside with that sell-off, and now we're just getting a slow recovery back down. We haven't really broken the low of the initial move to the upside right around here. So if we are going to be breaking, it would make sense that the VIX would hold this and start the trend up higher. Kind of like we're holding this zone right here as a previous, and then we get another resistance, and we get another, well, this has just got crazy right here, but if this holds, that would be a little bit more of a risk-off sentiment, and because obviously volatility increases when the moves to the downside appear, but we don't really see that just now, so it's a little bit too early to tell in my personal belief, but we'll see where it goes. We're just in a squeeze. Sometimes you just can't really do much, and you just got to sit on your hands, wait until there's a better opportunity. So that's going to be my view of the overall equity market. We're now going to jump into a little bit of oil, a little bit of bonds. Broke the previous support resistance and is holding for a new level of support in terms of Western Texas Intermediate, but we're consolidating. We're holding a lower high, so we can see right there we are holding a series of lower highs, which isn't great. And let's just connect the series of lower highs like so. So we got 3 touch points, making it a valid descending trend line, and we are just now at a horizontal level of support and a descending trend line, making this a descending triangle formation. You can also potentially call it a head and shoulders because this is the head. If you just go like that, that's not pretty perfect, but this is the right shoulder, that's the left shoulder. You got a little bit of a double head here if you go like this. But the formation is now attempting to make a move to the downside with a series of lower highs. And it's just a matter of time before we break the 35 level. But in terms of the shorter time frames, I think we could get a move to the downside here. Let's just quickly look on the 4-hour time frame and see what we can identify for potential zones. We already talked about that descending zone. And then now we're getting a small little consolidation where we're holding a previous support resistance into a new level of support. So if we break this to the downside, I think we could see a potential, let's just get our bars chart and something like this, where you get a big sell-off and you're getting something like this. And then you can maybe get like an ascending zone to connect the zone like so, and then you'd be looking for a break out of that for potential move to the downside or upside. Or it could just come down to the support level and then you'd just be forming a descending triangle. That would be another option that we'd be looking for, but definitely nothing crazy just yet in terms of moves. Brent is a very similar spot. Let's just get our trend line. It's not as nice of a trend line to draw, so I'm not going to draw a trend line there, but obviously these two are very highly correlated, so we are going to be looking at both of them. But in terms of overall, I don't know why this is bigger than that, but in terms of overall direction, we're in consolidation. If it breaks the descending zone and forms a higher high, that would be a potential continuation towards the upside. But in terms of the current price action we see right now, I would say that we're in a potential volume distribution phase where we have a higher probability of moving a little bit towards the downside, but inevitably it will be dependent on the overall market structure if we are in a risk on or risk off sentiment. But as of right now, we're in a consolidation just like we see in equities. Now we're going to get into 10-year and 30-year bonds. Obviously, if the yield goes down, people are getting into them and interested in parking their capital in a very safe investment that has not a lot of speculative potential because the yields are so low, but you're keeping your money safe, and that's definitely a sign of bearishness and risk-off sentiment if a lot of people are diving into bonds. Overall, we are just consolidating at the previous resistance, new level of support. It's a pretty key level of confluence here where you get a intersection between the ascending zone and the horizontal resistance, creating a key level of demand or support. But obviously it could break, and if it does break to the downside, it's definitely going to be a risk-off sentiment. People are going to be jumping into bonds, indicating that they're getting away from more speculative investments. So right now we're consolidating. I think all this will happen at once. So we're going to get either equities, like let's say if equities fall Oil will fall substantially, US bond yields will fall substantially, crypto will fall substantially, US dollar, JPY, CHF will go up substantially, odd New Zealand CAD will go down substantially. All of these big upcoming moves will happen at once. So you just have to decide, okay, well, where do you have the highest probability? What edge do you have within the market? And you just got to trade that edge and really, really practice it. So that's the overall analysis for bonds, oil, as well as some equities here. Quickly looking at gold, we are holding a consolidation zone. I don't really love it because we're not trending. We're just going sideways. There's so much noise happening right here. Massive sell-off, huge pushback up to hold the support zone. It's just really noisy, and I don't really love it, so I'm not really going to be looking at the price of gold too much until we get a nice little break here. We do have a potential squeeze, but as of right now, I'm not really seeing any momentum coming into gold, so I don't really want to be focusing on it too much. So that's going to be the potential squeeze that we see. Previous resistance is creating a new level of support. If we get into the 12-hour, that's going to be a big wick to the downside. We're squeezing in volatility and volume, and I think we could get, if we get a break to the upside, a retest of this previous resistance, which is going to be acting as a new level of support. And if it breaks this nice consolidation zone right around here, that could be a potential, but I think the main zone that I'd like to see break in order for gold to start trending again would be around 1745. That would be the zone that I'd want to see gold break in order for me to really start thinking of gold as a potential trend continuation setup that I would take. Silver is in a very similar boat, just consolidating sideways. I don't really see any trades for silver. Got rejected pretty hard by the buyers here. It was an initially bearish breakout, but the buyers, with that huge bullish engulf in Canada, bring it back up to the previous support, new level of resistance. And it does look like we're actually breaking that support zone. So overall, a little bit more bullish, but in my opinion, with the look of this chart, there's nothing really to trade as of right now. Gold and silver ratio, just consolidating, holding that key structural support that we talked about for a while here, so not surprising that the metals are just going sideways. If it does break to the downside, and if the gold and silver ratio goes into the ascending wedge, definitely it's going to be looking a little bit more bullish for the overall metals and going to be very bullish for silver more than gold, in my personal opinion. But we don't see that right now, so I'm personally just not going to be looking at them. I'm just going to be staying patient. Or I'm going to be looking at them, but I'm not going to be taking action. I'm just going to stay patient and basically sit back and wait for my opportunity here. So that is the global macro update. Not really going to get into FX for today. 33 minutes. I'm going to quickly look at some questions, but I will end the recording off there. Thank you very much for coming to our global macro update. If you did enjoy watching it, it'd be great if you would give it a thumbs up. If you would maybe subscribe if you are interested in watching more videos like this. You can get more videos if you put notifications on, and it notifies us and tells us that we're doing a good job. We're providing information that is valuable, entertaining, informational. Whatever the case may be, whatever you get out of it, it would be nice knowing that the time that we're spending here is getting put to use, I guess you could say. But that's the end of the global macro update. So I'm going to end it off there. Thank you very much for coming. Until next time, have a happy week and a good trading week as well. Bye now.